Technical analysis is like reading the story of a stock. It helps us understand where the stock has been and where it might go. It's about studying the charts and graphs, not just the company's numbers. We look for patterns and signals in the stock's price movements. These patterns can give us clues about the balance between buyers and sellers. Technical analysis is different from fundamental analysis. Fundamental analysis looks at the company's financial health, like its profits and debts. Technical analysis focuses on the stock's price history and what that tells us about market sentiment. Think of it like this. Fundamental analysis is like checking the engine of a car, while technical analysis is like looking at the car's mileage and service history. Both are important for making informed decisions. Technical analysis is a powerful tool for traders and investors of all levels. It helps us make sense of the market's ups and downs. Price action is the movement of a stock's price over time. It's the heart and soul of technical analysis. Every high, every low, every open, and every close tells a story. By studying these movements, we can gain insights into the market's sentiment and anticipate future price changes. Imagine price action as a conversation between buyers and sellers. When buyers are stronger, the price goes up. When sellers are in control, the price goes down. Our job as technical analysts is to listen to this conversation and interpret its meaning. We look for patterns and trends in price action to identify trading opportunities. For example, if a stock is making higher highs and higher lows, it indicates an uptrend, suggesting that buyers are in control. Conversely, lower highs and lower lows suggest a downtrend, indicating seller dominance. Understanding price action is crucial for successful trading. It helps us identify trends, spot potential reversals, and make informed trading decisions. Candlestick charts are a popular way to visualize price action. They provide a more detailed picture than simple line charts. Each candlestick represents a specific time frame, like a day, an hour, or even a minute. A candlestick has a body and two wicks, also called shadows. The body represents the opening and closing prices. If the close is higher than the open, it's a bullish candlestick, often colored green or white. If the close is lower than the open, it's a bearish candlestick, often colored red or black. The wicks show the high and low prices during that time frame. Long upper wicks suggest buying pressure but an inability to sustain those highs. Long lower wicks indicate selling pressure but a failure to break down further. Candlestick patterns like the hammer, doji, and engulfing patterns can provide valuable clues about potential trend reversals or continuations. Learning to read candlestick charts is like learning a new language, the language of the markets. Trends are the direction in which the market is moving. They can be upward, downward, or sideways. Identifying the trend is crucial because trading with the trend is like sailing with the wind. It makes our journey smoother and more profitable. We can identify trends by drawing trend lines on our charts. An uptrend line connects the higher lows, while a downtrend line connects the lower highs. When the price breaks above a downtrend line, it might signal a trend reversal to the upside. Similarly, a break below an uptrend line could indicate a potential downtrend. Moving averages are another helpful tool for identifying trends. They smooth out price fluctuations and provide a clearer picture of the trend's direction. Remember, the trend is your friend is a common saying in trading. By understanding and identifying trends, we can improve our trading decisions and increase our chances of success. Section 5. Support and resistance. Pillars of price action. Support and resistance levels are like invisible barriers on a chart. Support is a price level where buying interest tends to be strong enough to prevent the price from falling further. Resistance is a price level where selling pressure is likely to overcome buying pressure, preventing the price from rising higher. Think of support as a floor and resistance as a ceiling. When the price approaches support, buyers step in, preventing it from falling further. When the price reaches resistance, sellers take control, pushing it back down. These levels are crucial for traders because they provide potential entry and exit points. We might look to buy near support levels, expecting the price to bounce back up. Similarly, we might consider selling near resistance levels, anticipating a price reversal. Understanding support and resistance levels is essential for any technical trader. They help us identify potential trading opportunities and manage our risk. Section 6. Common technical indicators, moving averages, RSI, and MACD. Technical indicators are like tools in a trader's toolbox. They help us confirm our analysis and make more informed trading decisions. While price action is the foundation, indicators provide additional insights into momentum, trend strength, and potential reversals. Moving averages, or MA, smooth out price data over a specific period, helping us identify the trend's direction and potential support and resistance levels. Common types include the simple moving average, SMA, and the exponential moving average, EMA. The Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100. Readings above 70 are often considered overbought, while readings below 30 suggest oversold conditions. The Moving Average Convergence Divergence, or MACD, is a trend-following momentum indicator that shows the relationship between two moving averages of a stock's price. It consists of the MACD line, the signal line, and the histogram. Crossovers of these lines can signal potential trading opportunities. These are just a few examples of the many technical indicators available. It's important to remember that indicators should be used in conjunction with price action analysis, not in isolation. Section 7. Practical Steps for Beginners. From Strategy to Software. Now that we've covered the basics of technical analysis, let's discuss some practical steps for beginners. First, choose a trading strategy. Define your trading style, like day trading, swing trading, or long-term investing, and your risk tolerance. Select a strategy that aligns with your goals and personality. Next, select securities. Decide which financial instruments you want to trade, such as stocks, forex, or commodities. Focus on markets that interest you and align with your trading strategy. Then find a brokerage account. Choose a reputable brokerage that offers a user-friendly platform, competitive fees, and access to the markets you're interested in. Start with a demo account. Practice your trading skills and test your strategies in a risk-free environment using a demo account before risking real money. Utilize charting software. Familiarize yourself with charting software that provides the tools and indicators you need for technical analysis. Many platforms offer free and paid versions. Track your trades. Keep a detailed trading journal to record your entries, exits, profits, losses, and the rationale behind each trade. This helps you identify strengths, weaknesses, and areas for improvement. And finally, never stop learning. Technical analysis is a continuous learning process. Stay updated with market trends, explore new indicators, and refine your trading strategies over time. Remember, consistency and discipline are key to success in trading. Stick to your plan, manage your risk, and don't let emotions cloud your judgment. Section 8. Conclusion. Embracing continuous learning. Technical analysis is a powerful tool that can help traders and investors of all levels make more informed decisions. By understanding price action, candlestick patterns, trends, support and resistance, and technical indicators, we can gain a deeper understanding of market sentiment and potential trading opportunities. Remember, technical analysis is not a crystal ball. It's about probabilities, not certainties. There will be winning trades and losing trades. The key is to manage risk, stay disciplined, and continuously learn and adapt to changing market conditions. Embrace the journey of learning and refining your technical analysis skills. There are numerous resources available, including books, websites, online courses, and trading communities. The more you learn, the better equipped you'll be to navigate the exciting world of financial markets.